Okay, first leg collateralization, second leg liquidity. We're on the second of three legs before our drinks. Can I welcome Anthony and Scott Lucas, our community friends. I have to say, Greg and I had the privilege of, come on up guys, Greg and I had the privilege of spending time with Anthony and Natasha and Matt and Scott yesterday. And Scott's the only guy I know that uses the F word more than I do. Greg's laughing. And for those of you that know me, fungible is probably one of the most used words in my vocabulary. So, without further ado.
Thank you, Lawrence, as always. So I think Matt and Natasha teed us up very well for this conversation. So they were talking about the amazing potential of being able to optimize intraday liquidity. With Scott and Scott's team, we've had the privilege for working for the last year and a half on making that a reality. So we wanted to get into a little bit of that. Those who have the stamina that were here before lunch would have seen I did this short catalyst pitch with Richard Glenn from HQLAX, have a digital collateral solution, and Alina in Scott's team. Scott's team has been working with us on this project. So we wanted to talk about a little bit about that because a lot of people understand intellectually the potential of these things, but then they want to know how do you get engaged and what's it like to actually work with the project to make this happen. But Scott, I think everybody knows you, but maybe you can do a brief introduction on you, but then also talk a little bit about how you see this whole space. Matt talked about it, but how do you see the whole liquidity?
Sure, thanks. So for those people I haven't met, and there's a bunch in the room, I guess, my name is Scott Lucas. I work at JP Morgan. I've been there for about 14 years. I spent a reasonable amount of time in the sort of chief investment office, treasury sort of space in corporate, really looking at the end of that cycle at intraday liquidity across the franchise, and then a few years ago moved across to our markets business, which is the sort of broker-dealer trading side of the business, to see how we can develop solutions on blockchain that are additive to the existing market. And I think that's a really key point. There's a lot of debate at these conferences and sort of generally around the topic around like it's sort of blockchain or existing infrastructure. I think the real key point that we're focusing on, and sort of particularly in this case, is it's the existing market infrastructure and some DLT solutions that bring something new. And so I think that's where we're really focused on this space. But before we go any further, I just wanted to sort of highlight that, you know, there's clearly a coalescence around trends in this area, and that's self-evident by the fact that you and I look like we've been dressed by the same stylist, and I think the same person.
Same tailor.
Dressed Matt the same this morning. So there's some sort of concentration of ideas that are starting to permeate the market in multiple ways.
We used to wear dark blue suits for the institutions. We've evolved, you see. That's what it is. So tell us a little bit. So we have this project we've been working on. It's called Project Prince. It was named after Prince Machiavelli because we thought it was a little bit Machiavellian what we were doing. How do you think about that project at the outset and what you were looking to achieve and where you see this on the broader journey that we're now on to open up and optimize intraday liquidity?
Okay, so I guess so Prince is a step in a path that we've sort of been on for a few years and will hopefully continue to, from a bilateral context into more of a market context over the next few years. And it's really based around the thesis that what this technology can do because of the precision of the minute-by-minute nature of the settlement. I don't mean instant, but the precise nature of the settlement. And the ability to execute that with an operational workflow that allows that to really happen, not rely on existing technology and existing processes that don't have that same level of precision. You can transform some of the funding requirements of institutions. And when you think about liquidity in the round, we have a forecast, and it's interesting the way we went after this, after the crisis. It was like, let's solve the 30-day problem, the 90-day problem, and the one-year problem, and then let's make sure that intradays last, even though if you don't get to the end of today, we'll still be there in 30. So the end result is like liquidity is a time horizon that sort of we need to think about the risks for, and we've got to start today. And most frameworks have stress out to 30 days. You've then, you know, you've got LCR and NSFR that take you further down that horizon. There's a number of assumptions about how much liquidity you need to hold per business to meet your obligations as an institution, particularly on the sell side. And that means there's a funding requirement. And that funding requirement consumes a lot of balance sheet specifically to be able to meet your obligations. And that's the right posture to take. We want to be there through the cycle. We want to make sure that we're funded appropriately to deal with sort of stresses and strains in the market. But I come back to the point of before this, there wasn't the opportunity to have just-in-time funding. So you have a lot of just-in-case funding. And the thesis that we've got is actually if you can transfer some of your just-in-case funding to just-in-time by doing it today, you can manage the volatility levels, you can actually put some of those resources back into circulation. I can maybe use them twice a day if I use them in Asia and I use them in Europe. I can maybe bring some resources to bear that actually I'm not really going to take risk around some assets that are relatively illiquid and I can't get a price for, and I certainly couldn't mobilize if I had to if I'm trying to fund my book, but actually they're good enough collateral on a rolling basis because if they're okay, if that institution is okay today, I'm really just securing that transaction. I'm comfortable with the risk base, but I drop my risk exposure by assuming taking something, even if it's not the type of collateral I need to take for the longer term. So to get to the specifics of that, what do I mean is if I've got a intraday liquidity buffer that sees me through a 30 and 90-day cycle, but my assumptions for a particular bit of the business means that actually if any institution is in stress, the likelihood of participants trading with them drops. Most settlement cycles are inside 5 days. So you can naturally assume that over a 5 or slightly longer day period, your requirements for that funding drop away quite quickly. But yet I've got liquidity for 90 days. So if I can bring that curve in, I can fund the excess bit of that buffer on a daily basis, rolling. I feel comfortable about the access to that liquidity. I can go to the market and fund that a lot cheaper than I can get it from internal treasury because they have to fund me at 90 days and there's a single price for that and that's more expensive. So if I can now sort of do that, we've been doing that bilaterally with clients. We've been offering that service as a lender through intraday repo. We're now starting to look to lend cash into our business. But that's JP Morgan bilateral on our platform. That's not a market. Where we want to go is actually to, and this is where Prince comes in, is to extend that. So we've got a source of collateral through our digital financing platform. HQLX has a broad set of collateral available through its platform. Anera has got the technical capability now to connect us. We've proven that technology works. We can take an instruction from WeMatch or a venue that says, hey, I'd like to do this trade. I'd like to generate collateral through HQLX and make it available at JP Morgan. That works. You know, we've proven the technology. We're a long way down the road with legals, and that's where we think the next step is in this market. So we say, okay, well, it's still JP Morgan cash. You've still got to face JP Morgan. To Matt's point on the last panel, other cash providers are coming. Other collateral solutions are coming. And so we see an opportunity for venues to compete in this space, be the place you want to go for intraday repo, for collateral and cash providers to bring resource to the market, and you know, to at least some extent build off the teeth-pullingly painful technology and legal work that's already been done through Project Prince to say this is how you can mobilize across different platforms. It was a really long answer. Hopefully it was not too boring.
It wasn't, and it was interesting actually because you said it's this journey we're on. Actually, the Prince project we're working on wasn't the start of your journey, right? As you said, you have invested, you know, JP's been able to invest in the Onyx digital assets platform, and originally, and you were doing DVP, you were doing these bilateral trades, but then you understood the importance of the market scaling, right? So Prince was where you think, right, well, so we've got collateral sitting, Guido, I can see there, he's got collateral sitting on one type of technology, sitting on R3 quarter, you've got Onyx digital assets. So how do you think about scale, right? So Prince takes you one step. How do you think about then this scaling out of the market across cash and collateral? Maybe the collateral first and then the cash, but yeah.
So I would say most people who aren't in this room or don't come to these sorts of meetings are pretty much bored shitless of blockchain. It's been promising to solve every solution in the financial markets and probably world hunger and peace for 15 years. Like it's, so having a conversation about that is relatively pointless. Pointing to trades that have real economic value, that lower the cost of funds for a trading desk, going back to like who wears the cost, lower the cost of the funds to a trading desk, brings resources to bear that are currently unusable, offers for cash providers who've got excess resources, extra P&L pickup, like showing them those trades that they're one, real, two, they're executable, and three, they've happened, I think is the way the market gets moving. And so like leading that through demonstration of actual key trades, I think is the key thing. And highlighting that, you know, there is a spread of tens of basis points on billions of dollars worth of funding that institutions can realize, like that's real money. And so when it comes to like what's the next step in building the market, it's not technical, it's not legal, it's appetite for people to say, okay, I'll wear the cost of the new product approval process, I'll wear the cost of having a conversation with a regulator because I have got a significant funding requirement that costs me a lot of money, and I can offset 5, 7.5, maybe 10% of that, which will be a big number. That's for an institution is going to be measured in the millions, probably tens of millions. And I see the value in doing that. And I'll see it on the forward. It's not a one-off, like I'll do it this year and never realize it. Like that's an ongoing outcome. So that's what I think the next step is. It is execution to then drive appetite, which will then drive adoption. Not selling a connectivity layer or selling a platform, whatever. It's actually about being very clear with the market. There's money in this for the resource provider and the resource consumer.
Very good. And we've got a lot of institutions, I think, in the room, a lot focused on this space. They might be forgiven for saying, yeah, we know Scott and Matt have significant resources, JP and Goldman, so somewhat been taking a leadership position, leading the charge, doing some of the heavy lifting, as I might say. If you're them as an institution, maybe you didn't have the scale of resources or Onyx, et cetera, how do they now engage in this with some of these capabilities that you and Matt and some of the other biggest institutions have been putting in place? How should they think about this, and how do they sell it internally? How do they get on board?
Well, I mean, I think it really comes back to that point around leadership by demonstration. Where's the price point that works for them? You know, at some point there'll be enough skin in it for any institution to say that particular trade works for this particular desk or this particular institution. Maybe I don't have my own platform. Maybe I can use HQLX as a collateral platform. Maybe I can use my bank as a cash provider. Maybe I can use Party or Finality or others as cash providers. And the good news is, I guess, is because a lot of that heavy lifting is done, the hard work is partly technical, it's partly internal risk appetite, but a lot of it is making sure that the documentation of the use of the platform and signing up to whichever platform you use, whether you use an individual bank platform or a market platform, it doesn't really matter, is above the threshold of where people will take risk and they put real money on it. And that's where I mean about the leadership by demonstration, actually doing the trades and putting real risk through the pipes. And, you know, on the upside of having a lot of resources, we have a lot of resources. A lot of resources means a lot of eyes. It means a lot of gateways to get through. So the threshold is high across any of the institutions. And so I think if you can point to the fact that ourselves, GS, and others are using these platforms, they're putting real risk through it. Our supervisors are comfortable we've got to the point where we can use that. Our internal control processes have all signed off on those things. It's probably rational to assume that it's an acceptable risk to take to use that platform, and that the terms and conditions of whatever platform you're going to sign up to that's got real risk on it is above the threshold acceptable for those institutions. So that then short circuits the need for another external opinion or, only internal validation is always going to be something that's required, but that external legal cost is sometimes a pretty high one. And we've seen that with the Intraday repo platform. You know, the first few clients went and got external counsel to validate what we thought we were saying was accurate. Rarely happens now, because there's enough evidence to suggest, yes, that's fine. There's enough throughput, like we're in the trillions now. There's enough throughput that people say, okay, well, if it's good enough for those sorts of institutions on a daily basis, it's above the threshold of acceptable, so now we can start moving. And I think that's probably one of the benefits of waiting, but in order to wait someone to go do something first. And I think there's places where we're happy to go first.
Yeah, so you guys, if I can say that, Scott and Matt are starting to put trades on the blotter. They've spent money with lawyers. You started to tackle some of those legal hurdles that people will be facing and other institutions are worried about. You didn't answer the question much in terms of technology, right? You're talking about a business case. You're talking about legal, you know, Onair is a tech company that can orchestrate these transactions across these different platforms, right? That's less of the issue, right? It's being able to make the case internally and also explaining internally that, you know, Scott, Matt, doing this, they're putting trades on the blotter, this is out there, these problems are being solved, these legal problems are being tackled, and they need to get on board, right?
Yeah, I mean, the technology is, it's an interesting one in this space, because the technology is the key enabler for some of the specific attributes of these types of transactions that have to exist in order for the thing to work. That time specificity, the DVP in a different way that enables this sort of transformation from just in case to just in time. So I can execute a trade today, I can settle it today, I can mature it today, I've got no balance sheet consumption, I've got a different profile to that transaction. So the technology is really important in that. But I haven't met anyone in the room, but I've never gone into a bar and started talking to someone at work and go, so what ledger do you use, mate? You SAP or an Oracle guy? Like, that's not a conversation we have. And so, like, you know, that I'm not sure why that still permeates. And part of it is because, you know, to reach nirvana, you know, if you're a blockchain nirvana person, then at some point the whole world's going to be on, everything's going to be seamless, you can fractalize everything, you can trade for 24/7. So, like, that's never happening. But, I mean, I don't use probably more than 5% of the capability of my iPhone. I still have one. You know, I probably don't use more than 10% of most of the technology capability in my house. I still have it. So we don't have to realize every single benefit to the full extreme to get value of investment of using distributed ledger technology or blockchain in the financial markets. If it solves a specific problem, in this case, it solves a specific problem around the speed and precision of settlement that de-risks something that we can't do today, that's good enough. There's money in that. Let's do that. And then over time, we'll figure out, like, it is a better technology for a lot of things. I completely buy that. But you can't snap your fingers and change the infrastructure. Like, that just takes momentum, proof, need to get there. And some of the other stuff will absolutely happen. It'll just probably take a little bit longer. So
it's step by step, there's business value in these things now, right? And, you know, we had these like Onera routers in JP and HQLX, et cetera. You know, the pieces are there so that an institution come along, they may just be a borrower and lender wanting to interact with these platforms, and they may have forms of digital collateral, digital cash, and they can start to plug into that and scale that out. Lawrence is looking at me. Are we getting to time up? I don't know if there are any last questions for Scott before we wrap in this topic.
Must be interesting to work for a bank where you have a CEO who sometimes comes out with some, not very committed on crypto, and then he is. At the same time, you're probably one of the most busy banks in terms of, digital assets. But I guess, when do you believe that the US will really come out and embrace crypto? Is it really waiting for the regulator to act?
So I think they're two very different things. The technology that is a distributed ledger is another version of Oracle or SAP. Crypto is a different asset class. So to me, they're two completely different conversations. One's about space travel and one's about underwater travel. Like, I mean, they're just that separate. So I don't see the challenge as an institution in the fact that we don't have an enormous risk appetite for crypto at the moment. And the fact that we're very busy in building like products that trade on distributed ledger. I see there's a significant gap between those two things. When it comes, I mean, this is my view, not JP Morgan's view. I think personally, you know, crypto in the US, what would it take for crypto in the US to get a bit more available? I think it's reasonable to assume that whoever wins in November will be a slightly softer administration on the opportunity to use the technology and this particular sort of evolution of the market into the digital asset space. Even if Trump wins, he's probably the most friendly. The belief that he would come out on day one and sign an executive order that, hey, like, have at it, like, you know, we're in our crypto-friendly country and you can do what you want, is one, unlikely, because you've got a bunch of other things that are slightly more important, and two, that would have to be consumed by regulators. There'd probably be some debate around that executive order, as there often is, or maybe just ignore it. And then even if it was responded to, that would take quarters or months. Regulators would have to consume that. We would have to then assume like what that looks like from an internal risk appetite. The market would need to respond. So I don't see a situation in 25, it's floodgates. There might be pressure, but I think it'll take longer than that. Even in the sort of best case for the crypto space. Having said, like, it's a difficult one for JP Morgan. Like, we don't have the internal risk appetite or permission to operate extensively in that space. We do some stuff at arm's length. There's an AP for the ETFs. We do cash settled futures. We've got the permission to do that, but you could do that on toenails for like it doesn't really matter. I think until there's a client appetite and there's clarity around what we can do and there's appetite internally, then it's not a space we want to operate in. That doesn't mean it's not a valid and interesting market. There's a whole bunch of other valid and interesting markets we don't operate in. It's just not the right choice for us and our clients.
And often you're focused on much bigger problems, right? So you're dealing with much bigger markets, how to optimize intraday liquidity, how to start to use these capabilities to deliver this
I'd say
scale.
Different rather than bigger, because if you say bigger, there's a natural sort of hierarchy that's there. I don't think that's the right way to think about it. I think, you know, there's a very interesting, high activity, valid, you know, set of participants that want to do things in the crypto space. That's just not our role as a company. We don't have the risk appetite for that, like we don't have the risk appetite to other things, and that's okay. But we do genuinely, at Jamie Down, believe in the validity of emerging technologies providing better solutions for our clients and for the market. This fits firmly in that space, and that's why we invest in it.
Very good. So I think we'd like to thank Scott and Matt before. You know, these guys are taking a leadership position in the industry. A lot of the hard work has been done the last few years that the industry can actually stand on the shoulders and start to leverage, right? We are getting solutions now that enables optimization of intraday liquidity to start to do that at scale. And please talk to us, talk to Scott, Matt, and how you can engage in that and help this market scale across multiple sources and being able to orchestrate these transactions across market participants, right?
Thank you.
Thanks, Scott.
Always a pleasure, sir. Always a pleasure. Yeah.